What's up, everybody? Welcome to Heresy Financial. My name is Joe Brown, and today we are looking at a sign that is, quite frankly, a little bit scary regarding equity markets. We know that typically big money leads markets and small money, or sometimes called dumb money, ends markets. And here's what I mean by that. When you look at big money going into or coming out of assets, it's usually doing it at the right time. When you look at small investors, retail investors, the moment they get into something is usually indicative of a top, and the moment they sell something is usually indicative of a bottom. So we're going to look at a couple indications today that might indicate we are starting to see kind of this phase where big money is selling and retail investors are piling in. But that doesn't mean you can't make money from it. Ready? Let's dive in. All right, guys, so there's this great article, really brief report from the Feld report that I sent out in my newsletter this week. And just in case you guys aren't signed up for my newsletter, it's free. What I do is every week I just send out an email with 4 or 5 of my favorite articles that I found and read that I learned something from that week. You can sign up for that in the description below. But in this one, I'll throw the chart up on the screen. You can see here the stocks and insider activity chart that shows when insiders are buying versus selling for the most part, and how that corresponds to prices in the stock market. The red dashed line is the 3-month insider sell to buy ratio. The red straight line or solid line is the 12-month insider sell buy ratio, and the blue line is obviously going to be the S&P 500 index. Now, anytime you have a line or an average on a chart that has a specific time frame attached to it, like a 3-month average or a 12-month average, the longer the time frame, the more smoothed out that line is going to be. For instance, if you're looking at a chart of a stock and you're looking at a 50-day simple moving average versus the 200-day simple moving average, you're going to notice the 50-day moves up and down is a lot more volatile because it's only averaging together the last 50 days worth of prices versus the 200 days averaging out to 100 days. And so it takes a lot more of a significant movement in the underlying what is actually happening to cause that line to move. Now, this is significant. Let's look back at the buy-sell ratio or the sell-buy ratio. If you look at the solid red line, you can see that over the last couple of months, it has gone vertical. We can also see that the dashed line went vertical sooner and has gotten a lot more severe in terms of how many insiders are selling and buying. What I also want you to take a look at is January and February of 2020. Insiders were selling. January and February of 2020, the information about the coronavirus was already available. I made a video about it in January. But the stock market overall didn't catch on until the very end of February. I think February 28th is when the crash really started. Insiders were selling before that. Now take a look at what happened at the bottom. Insiders were piling money into the stock market. As soon as they knew the money printers were going to turn on, and as soon as they knew the government was going to try and bail out the entire economy, insiders started buying like absolute banshees. So it's pretty clear that insiders are selling right now and doing so at a rate that they rarely do. Well, right about now is when the retail investor starts to invest. Right about now is when the retail investor is flush with cash, has seen the economy and the stock market start to recover, and is starting to feel more confident and less scared, and the retail investor has no idea about the real problems with the economy, the real problems with government bailouts, government money printing, and valuations and asset prices right now. And so right about now, historically, is when retail money starts to pile in. So we would expect to see a large amount of retail cash right now, ready to be plowed in. So is that the case? Absolutely. Take a look at what Jamie Dimon just said recently about cash deposits at Chase. Number one, credit cards have been paid down a ton. People have been deleveraging with their highest interest rate debt as they've been receiving additional income from the government. Deposits over the last quarter at Chase increased by 24%. to over 2.2 trillion. There's a massive amount of cash just waiting to be deployed by regular old people. And at least at Chase, when they run the numbers, it looks like consumers have been saving about 30% on average of the stimulus checks they've been receiving. Now, what happens when regular individuals look around and they say, I've got a ton of money, I'm less scared than I was before, but prices of goods, of services, and of assets are running away from me. You're either going to buy stuff or you're going to buy assets. Because if you leave your money in the bank, you're going to watch the purchasing power dwindle away. Now, what's important to remember is that usually in these last final blow-off tops of markets before they really start to crash, as they start to rally, the rally becomes fierce and strong and quick and insane. And so it attracts more and more money because people are missing out on making money as they sit on the sidelines in cash. And so most people have a conundrum. You're looking at this and thinking, if I don't invest, I'm losing money. But if I do invest, I'm exposing myself to a massive crash and I could lose money either way. And the VIX backs this up as well. The VIX is a measure of volatility of the S&P 500, and it is back down to levels not seen since before COVID. We've just seen a complete drop in volatility out of the markets as more and more money has just steadily been piled in. Now, it's important to remember that volatility is one of those things that oscillates as well. And so when you experience lulls in volatility, you should expect that a spike in volatility is somewhere around the corner. You never know exactly when, but the fact that we've had steadily decreasing volatility for months now means that just that metric alone should give you some caution about the stock market. So what to do? If you can't invest because a crash is coming, but you can't stay in cash because you're losing money because all the assets are running away from you, what to do? How about hedge? How about buy a bull call spread on the VIX? How about buy some puts on your stocks and sell some calls to pay for them? If you don't know anything about options, I can teach you exactly how to use these strategies. They're very simple once you get the basics down. Check out my options courses for both beginners and advanced option strategies linked in the description below. But if you don't want to touch that, at least invest in an active fund where you have somebody who's paid, who's good at it, who's actually taking the money in the fund and deploying it strategically instead of just blindly throwing money into the stock market. Because these active funds are poised to just blow away passive funds over the next 5 to 10 years, as they're going to take huge advantage of these value names who haven't experienced some of these insane valuation explosions, and they're going to buy the dips on some of these companies that have great growth prospects. So I'm fantastically bullish on active versus passive right now. You're still going to have some volatility short term, of course. You'd still have some exposure to some big drawdowns, but the potential to recover from there and make more money than passive long term is huge right now, maybe more than in decades. So it looks like we're entering the final blow off top here, especially in equity markets, as retail money is starting to come in and big money and insider money is starting to get out. But I like to have my cake and eat it too. Ride the wave up, make sure you're protected on the way down. As always, I really appreciate you guys. Thanks so much for watching. Have a good day.